Something important is happening inside the banking system, and most people are looking in the wrong direction. They are looking for a dramatic event. They are waiting for a headline. They think the danger will arrive as a collapse, a bank run, a politician standing at a podium, or a central bank making a sudden announcement. That is usually not how systems change. Most systems change quietly. They change through rules. They change through incentives. They change through compliance departments, legal language, deposit insurance limits, digital monitoring, dormant account laws, capital controls, and the steady expansion of what governments and banks are allowed to do when the system is under stress. I have spent my life studying systems. I learned that you cannot understand money by only looking at the money. You have to look at the structure around the money, who holds it, who controls access to it, what happens when the institution holding it gets into trouble, what happens when a government says stability matters more than your immediate access, what happens when a bank decides that you are not the kind of customer it wants anymore. These are not abstract questions, they are practical questions. They determine whether the money you believe you own is actually available to you when you need it most. I want to be very clear at the beginning. This is not about panic. Panic is almost always a bad decision. Making state when people panic, they stop thinking in probabilities. They stop separating what is real from what is emotional. They make moves that solve one fear while creating three bigger risks. This is about understanding. When you understand how the banking system works, you do not have to be frightened by it. You can build redundancy, you can reduce single points of failure, you can avoid naive assumptions, you can protect yourself by thinking in principles rather than slogans. The principle is simple. A bank account is not the same thing as a pile of cash in your hand. A bank account is a relationship inside a regulated system. That system has rules. Those rules can change, and in a crisis, the rules that matter most are usually the ones ordinary people never read. The first thing most people assume is that if a bank gets into trouble, the government will simply rescue it. That assumption comes from history, and I understand why people have it. For much of modern financial history, when banks failed or came close to failing, governments often stepped in. They used taxpayer money, they guaranteed deposits, they stabilized the system from the outside. But after the financial crisis, policymakers faced a very uncomfortable question. Why should taxpayers always be the first line of defense when a bank takes too much risk or when losses build inside the financial system? So the system began moving away from bailouts and toward bail-ins. That sounds like a technical difference. It is not. A bailout is when outside money comes in to save a failing institution. A bail-in is when the institution is stabilized by imposing losses on people connected to the institution itself. The order generally begins with shareholders, then it can move to bondholders and other creditors, but after that, large uninsured depositors can become part of the loss-absorbing structure. That phrase is very important. Uninsured depositors. Most people think of deposits as money. In a legal and structural sense, a deposit above the insured limit can be something else. It can be an unsecured claim against the bank. That means if you keep more than the insured amount in one institution, the excess balance is not protected in the same way the insured balance is in the United States. The common insurance limit is $250,000. In other countries, the limits are different. The exact number changes by jurisdiction, but the principle is the same. Below the insured limit, the system gives you one kind of protection. Above it, you are in a different category. A wealthy person understands this instinctively. A business owner with payroll to meet should understand it. A retired person who sold a house and temporarily holds the proceeds in one bank should understand it. But most people do not think about it until stress enters the system. That is the dangerous part. When the weather is calm, all bank balances look the same on a screen. A person with $40,000 in one bank and a person with $900,000 in one bank may both log in and see numbers. The screen gives them the same emotional comfort, but structurally they do not have the same risk. The person under the insured limit has one kind of exposure, the person far above it has another. That does not mean you should distrust every bank. It means you should stop thinking that convenience is the same thing as safety. In my own way of thinking, the first protection against systemic risk is diversification. Not because diversification makes you rich quickly, but because it protects you from being wrong about one institution, one country, one currency, one legal process, or one timing window. Single points of failure are dangerous. One bank, one country, one currency, one access channel, one custodian, one assumption. Those are fragile structures. A resilient structure has backup pathways. The second quiet change has to do with accounts people forget about. This seems harmless at first. A person opens an account, leaves money in it, stops using it, maybe moves to another state, maybe forgets the account exists. After enough time, the account becomes classified as dormant. Most people would assume that if it is their money, it remains their money forever. In a moral sense, that feels right. In a legal sense, it depends on the rules. Many jurisdictions have laws that allow dormant or unclaimed assets to be transferred to the state after a period of inactivity. Sometimes the owner can later reclaim the funds, but reclaiming is not the same thing as uninterrupted ownership and immediate access. The process can be slow, it can be bureaucratic, it can require documentation, it can create stress for heirs who do not even know the account existed. And the important part is that some dormancy periods have shortened. In certain places, timelines that used to be longer have been compressed. Schemes that once applied mostly to bank accounts have been expanded to include other financial assets such as investment balances or insurance. Related assets, you can see the direction of the system. Governments and regulators are trying to bring idle assets back into visible legal channels. From their perspective, that may sound efficient. From the asset owner's perspective, it creates another risk. Money that is untouched for long enough may not remain quietly waiting forever. Here is the principle I would use. Do not confuse passivity with safety. A dormant account is not a protected vault. It is an account that can eventually trigger a legal process. If you have old accounts, old insurance balances, old investment relationships, or accounts opened for family members years ago, neglect is not a strategy. The system rewards documentation, it rewards activity, it rewards clear ownership records, it rewards updated contact information. It does not reward sentimental assumptions. The wealthy tend to understand this because they build systems around assets, they keep inventories, they have account lists, they update beneficiaries, they keep contacts current, they make sure heirs know what exists. Ordinary people often do the opposite. They rely on memory. Memory is not an asset protection system. The third risk is more serious because it changes the relationship between guilt and seizure. Most people believe assets can only be taken after a criminal conviction. That belief is understandable. It fits with the normal moral model of justice: first prove wrongdoing, then punish. But in many developed legal systems, authorities have tools that allow assets to be frozen or seized before a criminal conviction has happened. In some cases, no criminal conviction is ever required for the asset itself to become the target of the process. This is generally described as civil asset forfeiture or similar legal mechanisms depending on the country. The original intention was to target organized crime, corruption, money laundering, and proceeds of illegal activity. Those are real problems. Societies need tools to deal with them. But every powerful tool has a second-order consequence. Once a tool exists, its use can expand. Once the legal threshold for freezing assets is lower than the threshold for convicting a person, there is a gap. And inside that gap, innocent people can experience enormous pressure. If an account is frozen, the account owner may not be able to use the money while the case moves through the system. The process can take time. Legal representation can be expensive. The burden can feel reversed. Instead of the government proving you did something wrong before touching your assets, you may have to prove that your assets should be returned. For a large institution, this is an inconvenience. For a family, it can be devastating. That is what people miss. Financial risk is not only the permanent loss of money, sometimes it is the loss of access at the wrong time. If your money is frozen for a year but eventually returned, the legal record may say you recovered it. But if you missed payroll, missed a medical payment, lost a business opportunity, or had to sell another asset under pressure, the real damage may already be done. Liquidity matters, control matters. Timing matters. When I look at systems, I ask where the bottleneck is. In this case, the bottleneck is not always ownership, it is access. You may own something and still not be able to use it. In a crisis, that difference becomes very large. The fourth risk is one of the oldest tools in financial history: capital controls. Most people in stable, developed countries think capital controls are something that happens somewhere else. They think of weaker economies, unstable governments, emerging markets, or countries with chronic currency crises. That assumption is wrong. Capital controls have appeared in developed economies during periods of severe stress. They can limit cash withdrawals, they can restrict international transfers, they can block foreign currency conversion, they can stop money from leaving the country, they can trap capital inside the currency and banking system where it already sits. The logic of the government is always the same. Stability first, prevent the system from bleeding reserves, stop a panic, slow capital flight, protect the banking system, protect the currency. The logic of the individual is very different. My money is trapped, my options are reduced, my ability to act has been taken away at the exact moment when action matters most. Both logics can exist at the same time. That is what makes the problem difficult. In 2013, Cyprus showed how quickly withdrawal limits and transfer restrictions can become part of daily life. Greece showed how a country under debt pressure can limit ATM withdrawals and banking access. Iceland showed that capital controls can last far longer than many people expect. The lesson is not that every country is about to impose capital controls. That would be simplistic. The lesson is that access is jurisdictional. Money inside one country is subject to the rules of that country. Money inside one banking system is subject to the stability of that banking system. Money inside one currency is exposed to the policy choices made around that currency. If all of your money is in one place, you are implicitly betting that place will never restrict you when you most need flexibility. That may be a good bet for some people. It is still a bet. The people who think in systems do not wait until capital controls are imposed to create options. Once controls exist, it is usually too late to move freely. That is why the principle is preparation before crisis, not reaction during crisis. But preparation must be lawful, it must be transparent, it must be tax compliant, it must be documented. Moving money abroad to hide it is a terrible idea. Moving assets into properly reported, legally compliant, diversified structures may be part of a broader resilience plan for people who need it. The difference between those two things is the difference between prudence and danger. The fifth risk is subtler. It is not about whether you can access your money, it is about what you are allowed to do with it. Governments increasingly shape the kinds of assets citizens can hold, the reporting required around those assets, and the tax or regulatory complexity attached to certain investments. Some countries make it difficult for residents to hold foreign funds. Some impose complex tax treatment on foreign mutual funds. Some regulators discuss limits on certain digital assets or stablecoins. Many are increasing scrutiny around cryptocurrency, foreign currency accounts, and gold transactions. Each rule may have a stated reason: financial stability, anti-money laundering enforcement, consumer protection, tax compliance. Those reasons may be legitimate, but the investor still has to understand the consequence. The more rules that attach to an asset, the more the asset is shaped by policy. I have learned that governments tend to prefer financial activity they can see, measure, tax, and control. That does not make governments evil. It makes governments governments. The mistake is expecting a government to prioritize your optionality over its own policy goals. If a government wants to discourage capital leaving the country, the rules will reflect that. If it wants to discourage certain digital assets, the rules will reflect that. If it wants more visibility into gold transactions or foreign holdings, the reporting framework will reflect that. The practical lesson is not to chase every asset that feels outside the system. The practical lesson is to understand that every asset has a rule environment. Stocks have one environment. Bank deposits have another. Cash has another. Gold has another. Crypto has another. Foreign funds have another. Real estate has another. A good financial structure does not only ask, what can this asset earn? It asks, under what conditions can I still hold it, move it, report it, sell it, borrow against it, or pass it on? That is a more complete way of thinking. The sixth risk is the one most people feel but do not name correctly. Currency debasement. When central banks expand the money supply faster than the productive economy expands, the value of money is diluted over time. People experience this as rising prices, lower purchasing power, and the strange feeling that they have more numbers in their account, but less real security. Inflation is not just a number released by a government agency. It is a transfer mechanism. It transfers purchasing power away from holders of money and toward those who own assets or receive newly created money earlier in the cycle. If you are sitting on cash earning less than the rate at which your purchasing power is falling, you are losing quietly. That is why the wealthy do not think of cash as permanent wealth. They think of it as liquidity. It has a job, it gives optionality, it reduces forced selling, it lets you act when opportunities appear, but held in excess for too long. It can become a guaranteed slow loss. Now add another layer to this. Central bank digital currencies. The debate around digital national currencies is still evolving. Nobody can say with certainty how every country will use them if they are implemented. But the possibility matters because the structure of money determines the range of policy tools. A digital currency issued directly or indirectly through central bank systems could, depending on design, make it easier to implement negative interest rates, programmable spending rules, targeted stimulus, expiration features, transaction monitoring, or restrictions based on categories of use. That does not mean every government will use all of those tools. But in systems analysis, you do not only ask what the system is doing today, you ask what the system will be capable of doing tomorrow. Capabilities matter. If a tool exists, future policymakers under pressure may use it, and policymakers are almost always under pressure during crises. So the question is not whether a central bank digital currency will automatically destroy financial freedom. That is too simple. The better question is, what would happen to my financial flexibility if money became more programmable, more visible, and more directly connected to policy decisions? That question is enough to make thoughtful people diversify their forms of liquidity. The seventh risk involves tax authorities and the power to freeze accounts. Every developed country has mechanisms for tax collection. That is normal. Societies need revenue. People should comply with tax laws. There is no serious wealth strategy that begins with ignoring legal obligations. But compliance and vulnerability are not the same thing. Even people who file correctly, pay properly, and report their international accounts can be concerned about aggressive enforcement actions, especially when accounts can be frozen while a dispute is being reviewed. International information sharing agreements have expanded. Tax authorities can receive data from foreign institutions. Cross-border reporting has become more automated. Legal cooperation between governments has become broader. Again, the intention may be understandable. Governments want to reduce tax evasion and hidden offshore wealth. But the consequence is that the financial lives of globally connected people are now much more visible and more interlinked with enforcement systems. If a tax authority believes something is wrong, it may try to restrict access to funds while it investigates. Depending on the country, the procedural protections may differ. Some jurisdictions require stronger domestic court processes, some require more specific treaty provisions and documented evidence before acting on a foreign claim. Others may be more willing to cooperate quickly. This is why jurisdiction matters. It is not because one should hide from lawful obligations. It is because due process matters. Legal standards matter, the speed at which an account can be frozen matters, the burden of proof matters, the availability of appeal matters. A resilient system is not a system that avoids the law. A resilient system is one that is built with the law in mind, with documentation ready, tax filings clean, and assets held in places where procedures are clear and predictable. The eighth risk is the one most people encounter without realizing it. Transaction monitoring. Every bank is now a compliance organization, as much as it is a financial institution. Anti-money laundering laws require banks to monitor customer activity. They look for patterns, they look for unusual transfers, they look for large cash movements, they look for foreign wires, they look for changes in behavior. Many people still believe there is a simple threshold. They think if a transfer is under a certain number, nothing happens. That is no longer the right mental model. Modern monitoring is behavioral. A transaction does not have to be above a formal reporting threshold to attract review. It only has to look unusual relative to your profile, your history, your geography, your business, your stated income, your previous transaction pattern, or the bank's internal risk models. Technology is making this faster. Artificial intelligence and behavioral assessment tools can flag activity at scale. Banks can share certain kinds of risk information. Compliance teams can freeze or delay activity while they investigate. Sometimes the customer did nothing wrong. Sometimes the bank simply does not understand the transaction. Sometimes the customer profile does not fit neatly inside the bank's preferred risk box. This creates a very modern problem. The system is becoming more data-driven, but not necessarily more understanding. Driven data can flag a pattern. It cannot always understand a life. A person may sell a property, support a family member abroad, receive an inheritance, move money for a business, buy an asset, pay for medical care, or reorganize finances after a divorce. To a human being, these are normal life events. To a compliance system, they can look like deviations. That is why documentation becomes power. If you know you are going to make a large transfer, have the reason clear. Have invoices, closing statements, contracts, tax records, or letters ready. Tell the bank in advance if necessary. Keep communication professional. Do not improvise explanations. After the fact, the goal is not to defeat the system. The goal is to reduce uncertainty inside the system. Banks dislike uncertainty. Regulators dislike uncertainty. Algorithms flag uncertainty. Documentation reduces uncertainty. The ninth risk is what I would call profile mismatch. A lot of people choose banks the wrong way. They choose based on convenience, an app, a branch near their house, a promotion, or habit. Then they get frustrated when the bank treats their perfectly legal activity as suspicious. But banks are not all built for the same kind of customer. Some banks are comfortable with ordinary wage deposits, domestic bills, and small transfers. Some are more comfortable with entrepreneurs. Some are more comfortable with international families. Some understand wealth. Some understand cross-border activities. Some understand large wires. Some understand crypto-related clients. Some do not want any of that complexity. If your activity does not fit the bank's preferred client profile, you may become a problem for the bank, even if you are doing nothing wrong. That leads directly into the next risk. De-risking. Banks sometimes close accounts, not because the customer committed a crime, but because the customer creates compliance work, reputational concern, operational friction, or perceived risk. This is called de-risking. It can happen to customers who send large international transfers. It can happen to people connected to certain countries. It can happen to crypto-related businesses. It can happen to politically exposed persons. It can happen to clients with complex structures. It can happen to perfectly legal businesses that a bank does not want to understand. From the bank's perspective, this can be rational. Compliance is expensive. Mistakes are costly. Regulators are demanding. If a customer is not profitable enough to justify the review burden, the simplest answer is to close the account. From the customer's perspective, it can feel arbitrary and humiliating. But feelings do not solve the problem. Design solves the problem. You want banking relationships that match what you actually do. If you move money internationally, use banks that understand international transfers. If you hold assets across borders, use institutions that understand cross-border reporting. If you operate a business that looks unusual, do not rely on a bank that only wants standard retail customers. The right bank is not just the bank that will open the account. It is the bank that understands why the account exists. The final risk is the restriction of physical cash. Cash is more than a payment method. It is a form of optionality. It is private. It is immediate. It works when systems are down. It does not require a bank's approval at the moment of use. That is exactly why governments and financial institutions increasingly prefer digital payments. Digital payments are easier to monitor, easier to tax, easier to control, easier to analyze, and easier to integrate into compliance systems. In parts of Europe, restrictions on cash payments have become more aggressive. In other places, the law may still permit cash, but merchants and banks make it increasingly difficult to use. Banks may limit cash services, businesses may refuse large cash payments, payment processors may shape behavior even when laws do not. This is not only a legal trend, it is a behavioral trend. Once a society becomes accustomed to not using cash, cash becomes less useful even before it is formally restricted. The risk is not that everyone must keep large amounts of cash. That would create its own problems. Cash can be stolen, it can be lost, it earns nothing. It may create reporting issues when deposited later. The deeper point is that a society with no practical cash option is a society where nearly every transaction is intermediated. And when every transaction is intermediated, access depends on systems. If the system works, it feels efficient. If the system fails, locks you out, flags you, freezes you, or excludes you. Efficiency turns into dependency. That is the pattern running through all of these changes. The modern financial system is becoming more efficient and more fragile. At the same time, it is faster, more digital, more connected, more automated, more convenient, and more powerful. But it is also more centralized, more monitored, more rule-dependent, and more exposed to institutional decisions that can affect individuals very quickly. I do not look at that as good or bad in a simplistic way. I look at it as reality. Reality is something you adapt to. The people who get hurt are usually not the people who saw the risk clearly and made measured preparations. They are the people who assumed the past would continue unchanged. They assumed a bank deposit was always fully protected. They assumed a dormant account would simply wait forever. They assumed assets could only be frozen after guilt was proven. They assumed capital controls only happen in faraway places. They assumed every asset would remain equally easy to hold. They assumed cash would keep the same purchasing power. They assumed digital money would always be neutral. They assumed tax enforcement would never accidentally touch them. They assumed small transactions would never be monitored. They assumed their bank wanted them as a customer forever. They assumed physical cash would always be accepted. Those are assumptions. Assumptions are dangerous when they are not stress tested. So what do? You begin with principles. The first principle is to stay legal. There is no resilience in breaking rules. There is only hidden fragility. A structure that depends on secrecy, non-reporting, or evasion is not a strong structure. It is a future problem waiting for the wrong letter, the wrong audit, or the wrong rule change. The second principle is to document everything important. If you cannot explain the origin, purpose, and path of a meaningful transaction, you are vulnerable. Not because you did something wrong, but because the system may not be able to tell the difference quickly. The third principle is to diversify access. That can mean more than one bank. It can mean keeping balances within insured limits where appropriate. It can mean using banks that match your profile. It can mean having backup payment methods for people with legitimate international needs. It can mean properly reported accounts in stable jurisdictions. The fourth principle is to keep enough liquidity, but not confuse liquidity with wealth. Cash is useful because it gives options, but too much cash held too long in a debasing currency creates a different kind of risk. The fifth principle is to think in time frames. A rule that does not matter today may matter in a crisis. A reporting requirement that feels harmless today may become more important when enforcement technology improves. A bank relationship that feels convenient today may become fragile when your financial life becomes more complex. The sixth principle is to understand your own profile before the bank defines it for you. Are you a simple domestic depositor? Are you a business owner? Are you internationally connected? Are you holding large uninsured balances? Are you making transfers that may look unusual? Are your accounts inactive? Are your records ready? The seventh principle is to act before stress arrives. That may be the most important principle of all. You cannot build a resilient system during a panic. You build it when things are calm. You review accounts when you are not under pressure. You move excess balances thoughtfully, not emotionally. You speak to tax and legal professionals before a problem, not after an account is frozen. You establish proper banking relationships before you urgently need them. I learned over decades that the biggest risks in life usually come from combinations. One rule by itself may not be catastrophic. One bank account above the insured limit may not matter. One dormant account may not matter. One foreign wire may not matter. One cash restriction may not matter. One compliance delay may not matter. But combine them. A person sells a property and temporarily holds a large balance at one bank. The balance is uninsured. The bank is not used to the customer's new transaction pattern. The customer sends money abroad to family. The transfer gets flagged. The account is reviewed. At the same time, the currency is weakening. The customer keeps too much idle cash because they are afraid of markets. They forget about an old account. Then a crisis hits. withdrawal rules tighten, and suddenly what looked like a normal financial life becomes a web of access problems. That is how systems break people, not always through one dramatic blow, but through interlocking vulnerabilities. The goal is not to predict every crisis. That is impossible. The goal is to build a structure that can survive being wrong. If you are wrong about one bank, you have another. If you are wrong about one currency, you have exposure elsewhere. If one account is delayed, you have liquidity somewhere else. If one transaction is questioned, you have documents. If one jurisdiction changes rules, you are not entirely trapped there. That is what resilience means. It is not fear, it is preparation, it is not paranoia. It is realism, it is not trying to escape the system. It is understanding the system well enough not to be trapped by its weakest points. Most people think wealth is only about making money. That is incomplete. Wealth is also about keeping control of money through different environments. Good times make people careless. Crises reveal who built properly. When banks are stable, currencies are trusted, cash works, transfers clear instantly, and governments are calm, everyone looks financially sophisticated. But when pressure rises, the hidden architecture matters. Where is the money held? Is it insured? Is it documented? Can it move? Who can freeze it? Which legal system governs it? What happens if the bank does not want the relationship? What happens if the government changes the rules? What happens if cash becomes harder to use? What happens if inflation erodes the value while you wait? These are not questions to ask after the fact. They are questions to ask now. I am not saying you should make extreme moves. Extreme moves are often emotionally satisfying and structurally foolish. I am saying you should review your assumptions if you hold large deposits, understand the insurance limits. If you have inactive accounts, update them. If you move money in ways that could look unusual, document the purpose. If you have cross-border exposure, stay compliant and understand the rules. If you rely on one institution for everything, consider whether that is wise. If you hold all of your wealth in one currency, understand debasement risk. If you assume digital convenience always equals freedom, think more carefully. If you assume cash will always be accepted, look at the direction of policy. And if you think none of this applies to you because you are not wealthy, that may be the most dangerous assumption. The less financial margin a person has, the more dangerous an access problem becomes. A wealthy person can survive one frozen account. A retiree, small business owner, or family with one main account may not be able to. The system does not only matter to billionaires, it matters to anyone who needs their money to be available when life demands it. That is why I would treat these rule changes as signals. They are signals that the world is moving toward more monitoring, more automation, more centralized control, more compliance driven banking, and more pressure on traditional ideas of financial privacy and access. You do not have to like that direction. You do have to understand it. In my experience, the people who do best are not the people who deny reality. They are not the people who complain endlessly about reality either. They are the people who look at reality clearly and adapt. They ask, what is changing? What are the incentives? Who has power in this system? What happens under stress? What can I do now that is legal, sensible, and protective? That is the way to think. Not emotionally, not politically, not reactively. Principles. First system, second action, third. The banking system is not disappearing. It is becoming more controlled, more digital, more monitored, and more rule-bound for many everyday transactions. That will feel normal and convenient. But for meaningful amounts of money, unusual activity, international movement, large cash needs, or complex family and business situations, the new system can become much less forgiving. So build a life that does not depend on one door staying open. Keep more than one door, keep records. Keep relationships with institutions that understand you. Keep enough liquidity to function, keep your tax and legal position clean, keep your assumptions updated, and most of all, keep your thinking independent. Because in every cycle, people lose money not only because markets fall or banks fail, they lose money because they mistake the rules they remember for the rules that exist. Now the rules are changing, the system is tightening, the cost of ignorance is rising, but the person who understands the mechanics early does not have to be trapped by them. That is the point. You do not control the banking system. You do not control regulators. You do not control central banks. You do not control whether governments move toward digital currencies, whether banks deeply risk clients, whether cash becomes harder to use, or whether a crisis leads to capital controls. But you control your preparation. You control whether your deposits are concentrated. You control whether your records are organized. You control whether your account relationships match your real needs. You control whether you wait for stress or act before stress. And in a world where financial systems are changing quietly, that kind of control is worth more than most people understand.